Canada wants 53.5% of your income. Other countries want 10% or less. But a single mistake during your exit could cost you $500,000 in taxes. It just happened to someone I know, and I'm going to show you how to avoid it. And today I'm showing you the exact 9-step process to exit Canada for tax purposes and start paying 0% legally. So let's dive into it. Step 1, and this is absolutely critical, pick where you're going. So you can't just leave Canada, you need to establish tax residency somewhere else, or the CRA, the Canadian Tax Authority, will keep you in their tax net. For 0% tax, your options are pretty limited. So the UAE offers 0% personal income tax, 0% capital gain tax, and 0% inheritance tax. Singapore has a territorial taxation, so meaning foreign income isn't taxed. Check tax treaties between Canada and your destination, because these can dramatically reduce your withholding taxes and prevent double taxation. That is very important. Okay, let's move to step 2, what you need to do before you leave. Now, get everything established in your new country before departing Canada. This means visa, banking, local ID, and any business entities you need. Most people try to handle this after leaving, and that's a massive mistake. You want everything ready so you can make a clean exit. For UAE specifically, you will need to be physically here for 2 weeks to handle setup, and then you can return to Canada to execute your departure plan. Now step 3, and this step alone can save or cost you a lot of money. So you pay higher taxes as a non-resident on Canadian assets than a resident. So selling a Canadian business after you leave costs more than selling it before you leave. So if you have limited assets, sell everything and transfer the cash. Much simpler than dealing with deemed disposal after. And if you have substantial holdings, get professional tax planning. Don't sell everything at once, but definitely don't wait until after you leave. The key timing is this. Realize any capital gains exemptions while you are still a Canadian resident. Use your million lifetime capital gains exemption on qualified small business shares before departing. Moving to step 4, cutting your ties with Canada. Some people find this very difficult these days because the CRA determines your residency based on your ties to Canada. So you need to eliminate as many as possible. Some primary ties that will keep you Canadian residents are following. So for example, owning a home that is not rented. So or you need to sell it or you need to rent it out properly. Spouse or children remaining in Canada, so you need to bring them with you, and other personal property maintained in Canada. So if you still have access there to a property, they will see that as a tie to keep you as a tax resident there. There are secondary ties to eliminate are, for example, your bank accounts, credit cards. Close or minimize as much as possible. Your healthcare, you need to cancel it. Also, for example, club memberships and other social connections. And also the storage unit for your furniture, also important. And last but not least, ownership in a Canadian corporation. You will keep your passport, obviously, but everything else should go. So let's try to cut as much time as possible. And of course, if you want personal advice, always use a tax advisor or talk to us. And let's go to the next step. Step number 5 is your actual departure date. Fly one way to your new country and mark this as your official departure date. And this determines your tax year split. Immediately update any remaining Canadian accounts to non-resident status. Change your address to your new home country. And a tip from me, you could file Form NR73 asking CRA to determine your tax residency status. This gives them extra information to investigate you. Now step number 6, and this is where most people get crushed. And here's the big one that got one of our clients 80,000 Canadian dollars. Canada deems you sold all your assets at fair market value on departure date. So even though if you didn't actually sell anything. So you pay tax on paper gains. So what's subject to a departure date? That's your stocks, bonds, and mutual funds. Private company shares, and also jewelry, arts, and all the other things that are more worth than 25,000 Canadian dollars. There are some exemptions: your principal residency, your registered retirement savings plans, your tax-free savings account, pension plans, and Canadian real estate. And this is a step that hits the hardest and where most of our clients ask for help. And if this sounds overwhelming, visit emifast.com. We'll walk you through exactly how to avoid these massive tax bills. Build real substance in your new home country because tax authorities worldwide are cracking down on artificial arrangements. But aim for more. Get a proper lease, join business communities, establish local banking relationships. For the UAE, for example, minimum 90 days annually, but aim for more. Get a proper lease, join business communities, and establish a local bank account and really build a life here. This isn't just about meeting requirements. You need to have real ties so no other countries can claim that you're still a resident in your home country. Step number 8, cleaning up your Canadian business structure. Wind up your Canadian holding companies, operational companies in most tax efficient way possible. Very important to do this properly, and we always recommend a tax advisor for this. If you need one, you can always message us and we can help you out. Now let's tie everything together, because here's where people mess up and how to get the timing perfect. First of all, these are the biggest mistakes people make. Poor asset sales timing. The 20K departure tax bill happened because the assets weren't sold strategically. Keeping Canadian ties, so maintaining a home or leaving family, creates ongoing residency risks. No substance abroad, so just getting a visa isn't enough and is the most stupid one, the DIY approach. Canadian tax law is too complex for trial and error. So these were the 4 biggest mistakes. Now let's dive into the perfect timing sequence. First of all, plan 6 to 12 months ahead. Set up everything in your new home country, sell assets strategically while Canadian residents, and don't forget to cut ties systematically. Make a clean departure, file all your forms correctly, and build substance abroad. Every year delay is every day it costs you a lot of money. At Emifast, we have helped hundreds of Canadian entrepreneurs execute this process properly. We will analyze your situation and create a step-by-step roadmap that avoids expensive mistakes. Visit emifast.com to book consultations, and we will show you exactly what's possible for your specific situation. What is your biggest concern about leaving Canada for tax purposes? Drop a comment below, and if this opens your eyes to what's possible, smash that like button and subscribe, and I see you in the next video.